take from Powell's press conference after the Fed meeting this week. The first thing is that Powell said that the Fed are in no rush to adjust policy. They're conscious of both sides of the mandate, stable prices and maximum employment. And Powell emphasized the central bank's just not on a preset course, going to be data dependent. And if they ease too quickly, that could hinder the progress on inflation. But if they take too long to cut interest rates, that could dampen employment. So they're trying to balance those two factors together. Powell said that policy remains restrictive, and while balance sheet reduction will continue, the Fed doesn't need to see 2% inflation before cutting rates. So that's giving an indication that, moving towards willingness to cut rates. And he did mention uncertainty about policy and Trump's influence. Interestingly, he held back from commenting on President Trump's remarks about rate cuts, commanding the Fed to cut rates. And it was interesting to see Trump out with a fairly critical statement, just pretty much as Powell finished his press conference about what the Fed was doing. But the important thing for us is that there's a calendar event that's now really important, and it's this PCE print at 1:30 on Friday, January the 31st. And what we're looking for here is something that clearly gives the Fed some indication of what to do with rates. Now, the Fed's preferred measure of inflation is this PCE print. It has been since about 2012. So this inflation measure is the one that the Fed really pay attention to. So if this comes in outside analyst expectations, so say this comes in, the month-on-month comes in 0.3%, the year-on-year comes in at 3%, the month-on-month headline comes in 0.6%, this comes in at 2.9%. So this beats across the board. Markets will think, oh, the Fed are not on top of inflation. That would surprise all analysts surveyed. It's an inflationary pressure, and you'd likely see the dollar strengthen significantly and stocks sell off because the markets will think, well, the Fed has to be high for longer. However, if this comes in below expectations, 0.2% here, 0.0% here, 2.6% here, 0% here, and 2.3% here, then what you'll suddenly have is markets will go, hooray, inflation battle's being won. The Fed can concentrate on the maximum employment aspect of their mandate, which would mean they're more likely to cut rates. So that would be dollar weakness, euro dollar upside. That would be S&P 500 buying. That would be US 10-year bonds being bought. So that would result in yields going down. So that's what to expect. And Powell's commentary now just really helps us to focus on this calendar event. This is the one that really matters now. This is the one that will move markets if there's an out of consensus print. So although the actual decision itself was boring, as it were, and there was hardly any price action movements, it has set up a nice calendar event coming up for Friday.